Good morning. As the markets in North America are currently closed on this Tuesday, October 21st, 2025, we are looking at yesterday's closing figures. Bitfarms Ltd., trading under the ticker BITF on the Nasdaq, finished Monday's session at $4.98 per share. This close, however, masks the day's real story. The stock opened much higher at $5.40 and bled out all day, falling to a low of $4.84 before settling at that $4.98 mark, down about 0.6% on the day. This kind of intraday reversal, a weak open followed by a steady sell-off, often suggests that conviction is being tested, and it's happening after an incredible run-up. Now, most people looking at their Robinhood or SoFi Invest app see Bitfarms as a simple high beta play on Bitcoin. The expectation is straightforward. If Bitcoin's price climbs, this miner's stock will fly. It's seen as a pick and shovel play, and for a long time, that was the entire story. But here is the reality you absolutely must understand. That is not what this company is anymore. The $4.98 price you see doesn't just reflect the price of Bitcoin. It reflects a company in the middle of a massive, expensive, and incredibly risky identity crisis. Bitfarms is betting the entire farm, pardon the pun, on a pivot away from pure mining and into the high-performance computing, or HPC, and AI data center business. The stock's recent 400+% surge in just a few months isn't just about crypto. It's about the market trying to price in this transformation, and I'm not convinced investors fully grasp the risk. Let's start with the hard news that's been driving this. The expectation is that miners just mine. The reality is that Bitfarms is aggressively restructuring its entire global footprint. Just recently, the company announced it's shutting down its operations in Argentina, a move expected to be completed by next month. This follows the strategic sale of its massive 200-megawatt Yguazu data center. Why? To rebalance the entire portfolio to the United States. This isn't a minor tweak, it's a full-scale retreat from its international operations to focus on the U.S. market. This move is happening concurrently with its acquisition of Stronghold Digital Mining, cementing its new U.S.-centric focus. The company is telling the market that it expects to achieve greater yields per MW in the U.S., but this is also a strategic decision to plant its flag directly in the heart of the AI infrastructure boom. The real signal, the one that tells you this is not just talk, came just last week with a massive executive change. The company's chief financial officer is retiring. His replacement, effective October 27th, is Jonathan Mir. You need to look at his resume. This isn't some crypto-native accountant. This is a 25-year capital markets veteran from Lazard and most recently Bank of America, where he specialized in, you guessed it, energy infrastructure. You don't bring in a heavy hitter like that from the world of traditional energy finance unless you are deadly serious about becoming an energy infrastructure company. This is the kind of move that big Fidelity and Interactive Brokers clients, the institutional players, watch very, very closely. It's a signal that the company's financial strategy is about to look a lot more like a utility or a large-scale data REIT than a volatile crypto miner. This pivot is already consuming staggering amounts of capital. Just 11 days ago, on October 10th, Bitfarms announced it had converted a debt facility with Macquarie into a $300 million project-specific financing deal. This isn't just a general corporate loan. This cash is earmarked specifically to fund the development of its new Panther Creek HPC AI campus in Pennsylvania. The company immediately drew an additional $50 million on top of its existing balance, bringing the total drawn to $100 million, just to accelerate the purchase of long lead time equipment. This is on top of a separate, massive $500 million convertible senior notes offering the company recently priced. The company is hoovering up hundreds of millions of dollars, and this raises the critical question of dilution and execution. They are spending fast, and they are spending big because they are in a race. And that brings us to the central tension, the expectation versus the reality of this new market. The bull case, the story that has propelled the Bitfarms stock to these levels, is that this is a brilliant strategic move. They are leveraging their core competence, building and operating large-scale power-intensive data centers, to enter the white-hot AI market. They're partnering with established builders like T5 Data Centers to design the new, complex facilities which require advanced liquid cooling, a significant step up from standard crypto mining. The revenue forecasts reflect this optimism. Analysts are projecting a 66.5% surge in revenue for 2025. The company also maintains a very strong liquidity position, with a current ratio of 3.11, which is significantly better than the industry average of 1.78. And its debt-to-equity ratio looks very manageable at just 7.8%. On paper, it looks like a growth story with a solid financial footing. But the reality is far more dangerous. First, Bitfarms is not a first mover here. They are jumping into a pool where giants are already swimming. Competitors like Marathon, Mara, and Riot Platforms, companies with significantly larger market capitalization and deeper financial leverage, are already aggressively diversifying into the exact same HPC space. Bitfarms runs an extremely high risk of being out-executed, left to fight for the scraps of contracts after the tech giants have already signed high-margin, long-duration deals with its larger rivals. This isn't like Nvidia stock, which has a technological moat. This is a capital-intensive infrastructure build-out, and the player with the most capital and fastest execution often wins. Second, the bottom line is a mess. Despite the 66% revenue growth forecast for 2025, the consensus analyst estimate is for Bitfarms to post a net loss of 13 cents per share this year, and another loss in 2026. Think about that. The market is paying a premium for a high-growth story that is not expected to be profitable for years. The company's capital returns are deeply negative, with a return on equity of negative 9.9% and a return on invested capital of negative 9.5%. This tells you that right now, the company is destroying value as it spends, not creating it. This isn't Apple stock generating mountains of free cash flow. This is a cash incinerating venture justified only by the hope of future profits. So, what does Bitfarms actually do right now? It's a company with two brains. One brain is still a Bitcoin miner. As of its last update, it had a hash rate of 19.5 exahash per second. In the second quarter of 2025, it earned 718 Bitcoin. But, and this is critical, it sold 1,052 Bitcoin during that same quarter, raising $100 million. This company is not a Bitcoin hodler. It is liquidating its crypto assets to fund its corporate transformation. Its treasury is relatively small, holding just 1,402 BT as of mid-August. The cost to mine is also a concern. In Q2, its direct cost to produce one Bitcoin was $48,000. With Bitcoin's price being volatile, that is not a wide margin for error. This mining operation is now effectively a financing arm for the real business, the HPC build-out. That new business, however, is mostly just blueprints and press releases. The $300 million Panther Creek facility, for example, isn't even expected to be energized and operational until the end of 2026. That is a very long time to wait for a return on that investment, especially in a market as fast-moving as AI. This leads to the most baffling part of the entire Bitfarms story, the analyst rating. ratings. If you look at the 19 analysts covering the stock from major firms that advise on everything from Fidelity mutual funds to Schwab Intelligent Portfolios, the consensus is a buy. In fact, 19 analysts rated a buy, with 0 holds and 0 sells. That sounds incredibly bullish, right? But here is the disconnect, the part that screams reality check. The median price target from these same 19 analysts is $3.55 per share. The stock closed yesterday at $4.98. This means the consensus analyst target from the same people rating it a buy is 29% below the current price. This is a massive red flag. It suggests the stock has run up so fast, so far ahead of itself, that analysts haven't been able to downgrade their ratings fast enough, or they still believe in the long-term story but are acknowledging that the valuation has become completely detached from fundamentals. They are essentially saying, "We love the story, but we would not buy it here."